Good afternoon, and thank you for having me with you. I would like to thank the National Press Club and especially President Angela Grilling-Keane for not only inviting me to this prestigious venue, but essentially presenting the outline of what I want to talk to you about now. So it's as if we had prepared that together, which we have not. Now, let me first of all, of course, begin by wishing you all a Happy New Year. I guess it's still time to do that, given that we are just exactly halfway through between our Western New Year and the Lunar New Year, which will loom in a few weeks' time. I think it's also appropriate to wish ourselves a Happy New Year, given what I would like to talk to you about. It has to do with the global economy and what we should expect for 2014. Now, I'm going to test you numerology skills by asking you to think about the magic 7. Okay? Most of you will know that 7 is quite a number in all sorts of themes, religions, and I'm sure that you can compress numbers as well. So, if we think about 2014, all right, I'm just giving you 2014, you drop the 0, 14, 2 times 7. Okay, that's just by way of example, and we're going to carry on. So 2014 will be a milestone and hopefully a magic year in many respects. It will mark the 100th anniversary of the First World War back in 1914. It will mark the 70th anniversary, drop the 0, 7, of the Bretton Woods Conference that actually gave birth to the IMF. And it will be the 25th anniversary of the fall of the Berlin Wall, 25th. Okay. It will also mark the 7th anniversary of the financial market jitters that quickly turned into the greatest global economic calamity since the Great Depression. The crisis still lingers. Yet, optimism is in the air. We've left the deep freeze behind us, and the horizon looks just a bit brighter. So my hope and my wish for 2014 is that after those 7 miserable years, weak and fragile, we have 7 strong years. Now, I don't know whether the G7 will have anything to do with it, or whether it will be the G20. I certainly hope that the IMF will have something to do with it. Now, is this wishful thinking? No. But it will not happen randomly without us together, and policymakers in particular, making the right decisions, having the right policy mix, organizing themselves in a coordinated way. Let me talk about, first of all, the global outlook as we see it, and then I would like to touch on the policies that I believe will help us transform those 7 miserable years into 7 strong years. Now, I'm going to anticipate on potential questions that some of you might be tempted to ask by just stating clearly that I'm not going to give you the number of our revised World Economic Outlook number that will be disclosed on January 21st. Suffice to say that it will be directionally positive as a revision. But I'm going to discuss the main trends, but not the numbers. We saw the momentum strengthen in the latter half of 2013, and we believe that it will continue to strengthen in 2014, largely due to improvement in the advanced economies. Yet, despite that, and that directionally positive movement, growth is still stuck in fairly low gear. It remains below potential, which we believe is at around 4%, which means that the world could, if it worked at full potential, could create a lot more jobs than before, than we do have at the moment. And we could do that without having to worry about the inflation genie coming out of the bottle. With that positive initial statement, I would also like to add that it will not be without downside risks, and significant ones. With inflation running way below central bank targets in most corners, clearly we are seeing rising risk of deflation, which could prove disastrous for the recovery. If inflation is the genie, then certainly deflation is the ogre. That must be fought decisively. During the years of crisis, we have relied heavily on the emerging market economies and on the low-income economies to actually be the drivers of growth. And if you combine those two categories, emerging and low-income countries, they produced actually about 3/4 of global growth. However, a growing number of those emerging market economies are slowing down as the economic cycle turns. So that's also one of the risks that we see going forward. We also see risks arising out of the financial market turbulence and the volatility of capital flows. The reaction to the Fed's tapering has been calm so far, and this is partly due to the fact that we had had a dry run back in May and June. It is good news that this reaction was calm, but there could still be some rough waters ahead. Overall, as I said, the direction is positive. But global growth is still too low, too fragile, and too uneven. Moreover, even as it is, or as we forecast that it will be, it is not enough to create the 200 million jobs that are needed by people who are looking for a job everywhere in the world. Additionally, in too many countries, actually most countries, the benefits of growth are being enjoyed by far too few people. And just to give an example, in the United States, 95% of income gains since 2009 went to the top 1%. 95% of the income growth gains went to the top 1%. Now, this is not a recipe for stability and not a recipe for sustainability. Let's now turn to the policy recommendation. Because all of that really points to the fact that policymakers all need to stay focused. Focused on the policies that are needed for sustainable and inclusive growth, as well as rewarding jobs. We so far have certainly avoided the worst case scenario, and all policymakers have made part of the necessary efforts. Those that went clearly beyond, way beyond the call of duty, were the central bankers. They did that to keep interest rates low, and the financial system functioning, while government, in most places, deployed fiscal stimulus where they could, and applied adequate, sometimes a bit too much, fiscal consolidation where they should. The road has certainly been difficult and continues to be so, but as Edward Murrow once said, difficulty is the excuse that history never accepts. Now that the global economy looks more stable, the big priority for policymakers from our point of view in 2014 is going to be to fortify the feeble global recovery and make it sustainable. Great. What does it mean in practice? I'm going to run you through the advanced economies that I will take by groups, then the emerging markets and the low-income countries, as to what we see as a good coordinated policy mix that should be applied in order to secure and strengthen that growth and create those jobs. If we look at the advanced economies first, what it means is that, you remember what I said about the monetary policies applied by the central banks. Well, central banks are going to have to slightly, gradually, over time and properly communicated, undo what they have done. But they should not do that until growth is robust enough and firmly rooted. So the way in which tapering is applied, the way in which from unconventional to conventional they return, will have to be very well done. At the same time, countries will need to use the room created by that unconventional policies to put in place the reforms that are needed to jumpstart growth and jobs. So it's not just for central bankers to do some policy work, but it's also for the other players in terms of budgetary policy in particular. Now let me go deeper and touch on the different regions and look first at the largest economic player in the world, the United States. Growth in the United States is certainly picking up, driven essentially by private demand. And that recovery that we have observed in 2013, that unfortunately was dragged by the fiscal consolidation of 2013, will be helped by the loosening of the fiscal corset as a result of the recent budget deal. Still, it will be critical to avoid premature withdrawal of monetary support and to return to an orderly budget process, including removing the threat of the debt ceiling. If we look now at the euro area, the euro area is clearly turning the corner from recession to recovery. But when you drill down, growth is still unbalanced, with some countries growing reasonably well and some economies doing quite well, and others still lagging behind. And some of those are actually suffering from significant high debt and credit constraints as well. So here, monetary policy can continue to help. Clearly, the ECB has done quite a bit to facilitate the financing of the economy. But it can do more, and we believe that it can do so in a very targeted way by facilitating targeted lending in particular in order to avoid the financial fragmentation that is still there despite the unconventional policy that has been applied, including forward guidance. We believe that the forthcoming asset quality and stress test that will take place in the course of 2014 is going to help if it is done even-handed and in a credible manner, and obviously well communicated as well. In the euro area, we also believe that there is a need to accelerate reforms to boost labor market participation and enhance competitiveness, and that applies pretty much across most euro area countries. Let's now turn to Japan. In Japan, the initial boost from Abenomics and the three arrows has been effective, but it is weakening a bit. Hopefully, temporary fiscal stimulus that have been announced by Prime Minister Abe will actually offset, or at least partially offset, the negative effect, the necessary consumption tax increase, which is one step in the process of increasing consumption tax. Now, the challenge for Japan is to agree on medium-term fiscal adjustments, medium-term, and to the economic and social reforms that we believe are needed to strengthen growth in Japan. What do I mean by that? Well, deregulating the service and product markets that is heavily regulated and highly protected, and that's what I mean by social reforms, making sure that women in the Japanese economy can actually access the job market. I'm very pleased actually that Prime Minister Abe has listened to that recommendation and that he's including in his budget for 2014 significant amount of spending on daycare centers for Japanese women. Now, moving away from the advanced economies, let's look at the emerging markets. Now, the challenge there is going to be to navigate any bumpiness and stay strong. Policymakers may be wary of any signs of financial excess, and they should, especially in the form of asset bubbles or rising debts, including through backdoor channels or off-balance sheets instruments. Financial regulations needs to be strengthened and implemented in order to being able to better manage credit cycles. And yes, many countries also could do more on the structural front, if only by way of investing in the necessary infrastructure in a well managed and with a good strategy in order to remove the bottlenecks that some of those emerging market economies face as they have grown quite steadily over the last 5 years. What about low-income countries? Here, the news is generally good. These countries have really been the bright spot of the global economy. But now is the time to lock in those gains and to make sure that some of the buffers that they have used during the time of the financial crisis are reconstituted, and that they can build stronger defense against either the direct, by way of the commodity markets, for instance, or the consequential external shocks that could result from movement of capital flows that would weaken the growth in the emerging market economies that are typically the trading and investment partners of those low-income countries. In addition, countries should keep, those countries, the low-income countries, in addition to building the buffers, including by raising revenues, frankly, because they have had the benefit of strong growth, but we haven't seen in those economies an equivalent and proportional increase of their revenue. So they have to focus on that. But they also should keep on spending effectively and selectively on important social programs and infrastructure projects. I have to say that I'm just coming back from two fast-growing regions of the world. I was just before Christmas in Asia, visiting Cambodia, Myanmar, and Korea, which is certainly not in the category of the low-income countries. And I just got back from South Africa, Kenya, and Mali. And you know, those two regions have grown at a rate of 6.5% and 5%, respectively. And when we're here, Indy, often we tend to forget the massive movements that are taking place in those markets and how those economies are on the go, how the middle class is actually building and the economic power is strengthening in those areas. Everything is relative. Let's face it, anybody who's been to Mali will not say that the middle class is rising and everything is rosy. No. But there are massive changes underway, and the speed at which they're taking place is just phenomenal. Now, I will not close that sort of panorama of the global economy without mentioning the Arab countries in transition. And while you're right that we had to spend quite a bit of time on Europe and the euro area, we have also spent quite a lot of time on the Arab countries in transition to try to help them strengthen their economy in order to restore some political stability going forward. It's exactly 3 years ago that the Arab Spring started back in Tunisia and then spread out to the rest of the region. And as these countries grapple with the reforms needed to unleash the dynamism of their private sector and create more jobs for their young people, they need support, and they need international support in a significant way, and not just from next-door neighbors. So I've tried to take you through the various regions of the world, both in terms of where we see those economies, where we see them going forward, and I've tried to describe the policies and the coordination of policies that they should apply, which doesn't mean that there are no issues that actually cut across those different groups that require common resolve, common solutions to common problems. Think about the legacy of public and private debt, for instance. Think about the fiscal and current account consolidation. Think about the reforms to the financial system that do not apply only by virtue of the Dodd-Frank Act, but that apply across the board, because just like environmental threat, just like contagious disease, those issues know no borders. The same is true with rising inequality. As I mentioned to you, rising income has gone to 1% of the population. Now you will say to me, of course, it's as a result of the improvement of the security market. No, not only because of that. So those are problems that cut across all groups of countries. And they're not abstract challenges. So it's only by addressing them that we can actually ensure future prosperity, that we can meet the rising aspiration of the young people in those countries and global citizens more generally, for jobs, for security, for opportunity, and for dignity. So, I will conclude. At the outset, I made a reference to the Bretton Woods conference here in this country back 70 years ago, and the multilateral impetus behind the funding of the IMF, amongst others. Now, to move forward, and for the IMF to continue to be a supportive force, an ally, and a partner of financial stability that is needed for all economies to prosper, we need the same spirit of cooperation and global solidarity today. Some people sometimes worry and they wonder and they say, you know, why is it that the IMF is supporting Europe at the moment? And I remind them, back 70 years ago, the first countries that had the benefit of IMF support were European countries, like my country. France was actually the first program with the IMF, and then it moved around the planet. We had to help Latin American countries. We had to help Asian countries. We are helping African countries on a regular basis through our different lines of businesses. And we're helping Europe at the moment. And it will be another group of countries next time around. Now, I believe that the IMF can play an especially valuable role here as a forum, not just to lend and then collect back, as we always do, but also to operate as a forum for cooperation, for coordination. We have certainly played our part in the collective response to the crisis. We have made no less than 154 lending commitments and provided technical assistance to 90% of our membership since the onset of the crisis in 2008. And we've provided our best possible policy advice to all 188 members. One of the strengths of the IMF is that we actually see the bigger picture. And it's not me being arrogant about it. We just have to look under the skin of the economy of 188 members. And we have to compare best practices, and we have to offer advice that actually take into account what spillover effects will be as a result of the domestic policy decided by one country or the other. No other institution can do that at that scale, at that level. And the role will certainly become more important with time. We need to continue to adapt and to reflect the changing dynamics of the global economy and of our membership. That is why we need the continued support of our entire membership. I will end with one thing. I just would like to pay credit to your association and to the journalists who very often have this commitment to truth and honesty and do that sometimes in very difficult circumstances in very faraway places where they take risks, much more so than we often think of. And I will end with another icon of American journalism here. Now, I don't mean Ron Burgundy. I mean Walter Cronkite. And he actually says, you all know what he says, but he says something which I've heard President Chirac say so many times, in the French version, of course, during cabinet meetings. He used to say, after having described something horrendous happening in the world, and all of us, you know, sort of waiting to see what we could do, and he would say, voilà, c'est comme ça. So Walter Cronkite used to say, and that's the way it is. Thank you very much.